the useful starting point is say, well, what do we mean by private equity? Because that can mean different things to different people. If someone says private equity to me, I instinctively think of a private equity fund that has raised capital from institutions, high net worth individuals, pension funds, in order to invest in entities, companies, in a specific or varied markets in order to produce a desired return. But it can also mean any form of non-listed finance, really. It can also mean high net worth direct funding, family office funding, which is increasingly prevalent in our markets as well, particularly in the sort of private business space. So I will mention those other forms of finance at the end as well, but I'm going to focus maybe a bit more on the more traditional private equity route, because that's where we see the private equity being used as a means of exiting or partially exiting businesses in the same way as the listing. I suppose inevitably there comes a point with any business that's been successful where commercialization has occurred, where it's been demonstrated that there's either a really solid business which generates, very solid annuity revenues, but maybe can't be developed further, or where there's a business that has done exceptionally well, it's commercialized, and it's been demonstrated that it is scalable, or it can be developed into new markets, whether that be geographically or different product lines. But inevitably, that leads to a question of how that is going to be financed. And often the level of finance required to do that is such that more traditional forms of finance, whether it be bank debt or other forms of finance, just aren't going to really cut it in terms of getting you to where you need to be and the level of growth in the timescales that you're going to need.
In the case study we're looking at, the showstopper for listing seems to be, perhaps not a city-facing founder who can raise money, and there's not confidence in that. And I think that's a really interesting kind of position at where private equity, partnership may have been the way to go for this, because it's perhaps not at the stage where there's the expertise, in management to be able to run something, and maybe it needs another step before a listing takes place. And certainly, if you are looking at a London listing, you need the right board and the right composition, because, as Neil said, sort of corporate governance and your ability to face the London markets as a board and have the right people in the right positions is pretty fundamental. More so, I think, but more particularly with AIM. And to give a sense of the markets, because many on the call will know there's a number of London choices, and of course AIM has been popular for a number of years for some of its success stories of Hotel Chocolat or ASOS, and it's had some of those consumer brands and enjoyed successes from being a growth market. There's also the main board, main stock exchange board, through the FCA official list, and that has gained popularity as well, through, I guess, not having the nominated advisor that you get on an AIM listing. You're able to list without a nominated advisor always being there and being part of your day-to-day supervisory role.